Let's take a look at the Chapter 12 problems. This is an Excel file that we'll use to work on most of them. On the screen now I've got our ebook open, and I'm just on the easy problems 1 through 3 to start us out. And so the first one is Broussard Skateboards. They expect to increase sales by 15% from 8 million to 19.2 million. Assets totaled 5 million in 2019. They're already at full capacity. That's a big deal to know that. Assets must grow at the same rate as projected sales. At the end of 19, current liabilities are 1.4 million, and of that, 450,000 is accounts payable, 500,000 notes payable, 450 is accruals. After-tax profit margin 6. Forecasted payout ratio is 40. Use the AFN equation to forecast Broussard's additional funds needed for the upcoming year. Now, one thing I want to point out before we get too far in the problem is with the accrued liabilities, with the current liabilities, we never include debt in the AFN equation. So that 500,000 of notes payable should not be included. We want this to be spontaneous liabilities, which is essentially your accounts payable and your accruals. So that 500,000 that's here, we're not going to include that because debt is not spontaneous. You have to, sign a document, go to the bank to get approval before you can borrow money, such as a note payable. So let's go over to Excel, and I have right here the AFN formula. So recall from the book and the PowerPoint what this means. It has 3 sections. The first section is kind of the capital intensity ratio. Assets today times 0 divided by sales today multiplied by the change in sales. So that first part tells us what additional assets do we need to acquire to finance the growth. We're projecting a 15% growth. And then I subtract from that my spontaneous liabilities, L0 divided by S0, multiply that by the change in sales. And the third section is basically what will my net increase to retained earnings be. So PM is your profit margin. Sometimes it just says M. I like PM better because I think that explains it just a little bit better about what it really is. And then we get S1, sales for next year, times 1 minus the payout. So these last 3 items, PM, S1, 1 minus payout, is essentially the net increase to retained earnings that we expect. And that, of course, helps self-finance the acquisition of assets that we need. Okay, so those are the 3 categories. Let's just go through and solve for this. What I'll do is kind of solve for each section on its own. So let's solve for the A0 divided by S0 times change in sales. And so assets were 5 million. The change in sales was 8 million. I'm sorry, the sales number for the current year is 8 million. And we're going to multiply that by the change in sales. So we're taking 5 million assets divided by 8 million, divided by 8 million current sales multiplied by the change in sales, which is 1,200,000. We're going to go from 8 million to 9.2 million. Okay, so we'll go do that one first. So we get 750. Let's do the next one, which is L0 divided by S0 times the change in sales. And so remember that I don't include the debt. I only include 450 of accounts payable and 450 of accruals. Okay, so those 2 numbers is what I will use. So that's let me do a parentheses here. It's 450 plus 450. Okay. And then I divide that by my change in sales of 1,200,000. I'm sorry, divide that by sales first, 8 million. And then I take that calculation, so I need to add some more parentheses here, and I divide that specific calculation by the change in sales. Okay, then I get to my answer. Let's see, I didn't do something right. Multiply. There we go. Now I got it. So sorry about that. Let me show you what I did there. So the 450 plus 450 divided by 8 million, which is S0. Then I multiplied that by the change in sales of 1.2 million. So I get 135. And then we'll do the last one over here. So my profit margin that they gave us was 6%. I multiply that by S1, which is 9,200,000. I multiply that by the 1 minus the payout rate, which is 1 minus 0.04. And that gives it to me right there. So 5, let's see if I did that right. I need to do this a little bit differently. It's all about those darn parentheses where you've got them. There we go. Okay, so my profit margin times S1 times 1 minus the payout rate. And that gives me, whoops, that's 0.4. There we go, that's what I did wrong. We get 331.2. So there is my answer. So it's the answer for AFN is plus the 750 minus 135 minus 3312. Okay, and I get 283,800. Okay, so that's just the basic operation of the additional funds needed. Go back to the problems, question 2. It says here that Berman and Jacor Corporation's current sales and partial balance sheet are shown here. Sales are expected to grow by 10% next year. Assuming no change in operations from this year to next, what are the projected total operating assets? So just the key, just some key information here. They gave us sales, and on the balance sheet they gave us asset categories, all the current assets, net fixed assets, total assets. So we've got sales and all the asset categories. And so what we do is you take take everything and divide it by sales. Okay, so I'll show you what we do here. So I kind of just built some information here. So we just take every single item on the balance sheet and divide it by sales. So cash was 100, sales is 1,000, 10%. AR was 200 divided by 1,000, 20%. Inventory, whoops, that should be a divide. Inventory divided by sales was 200, oops, divided by 1,000. And then net fixed assets was 500 divided by 1,000. Okay, so what percent to total assets is each one? So projected sales then, remember that we expect to grow by 10% right here. Okay, so projected sales is this 1 plus 0.1, which is my growth. Multiply that by 1,000, which is my base number. And it's not too hard to figure out what that is. It's 1,100 is my projected sales. And so then the question is, well, what's my new numbers based on that? If we're holding these ratios true, what will these be? So it's pretty simple. You can probably see how we do it. We just take the projected sales number, multiply it by the various ratios. So my new cash number would be 110. AR would be the sales times the rate of 0.2, and so on. Inventory 1,100 times 0.2 again. Fixed assets would be 1,100 times 0.5 for 550. And then total operating assets is simply the sum of these three right here. So and then really the sum of everything. Operating assets includes the total fixed assets. So let's sum all those up, I should say, and we get 1,100,000. So or 1,100. So really easy. We're just basically saying these ratios will hold true for the next year. If sales go up by 10%, these numbers basically all go up by 10%. Okay, then question 3 is on the liability side. So it's kind of the same situation, but not the liability side. And it says Smiley Corporation's current sales and partial balance sheet are shown below. You can see it says sales are expected to grow by 10% next year. Assuming no change in operations from year to next year, what are the projected spontaneous liabilities? And you can see right here sales of 10,000 and the various balance sheet amounts are here. So they give us the entire balance sheet. current liabilities, long-term debt, equity, and so on. So kind of the same story as before. I've got that set up. We kind of take everything again and relate it back to sales. So accounts payable was 1,000. My sales was 10,000. My accruals were 1,000. And my sales were 10,000. And then, so my projections become, well, my sales, they told us, will go up by 10%. They like that number right here, 10%. So I just build a projection, nothing too major here. So I just go, 1 plus 0.1 is my growth, and I multiply that by the $10,000 current sales amount, and that gives me my growth number of 11,000. So 10,000 times 1.1 is 11,000. Then my AP is simply 10% of that, so 11,000 times the 0.1. Accruals, same story, 11,000 times the 0.1. And then I just add those last two numbers together. These two here, AP and accruals, that's my spontaneous liabilities of 2,200. Okay, then we'll move on to question 4. And with question 4, it's Maggie's Muffins. And kind of an interesting one. And this is going to be using the AFN again. So for Maggie's Muffins, it says they generated $5 million in sales during 19. Year-end total assets were $2.5 million. Also, year-end 19 current liabilities were $1 million, consisting of $300,000 notes payable, $500,000 accounts payable, $200,000 of accruals. Looking ahead at 2020, the company estimates total assets must increase at the same rate as sales. Makes sense. Spontaneous liabilities will also increase at the same rate as sales. Profit margin 7. Payout ratio is 80%. So the question then is, how large a sales increase can they achieve without having to raise funds externally? That is, what's the self-supporting growth rate? So we're going back to that concept of the self-supporting growth rate. And so I've got something built for us over in Excel. So with this one, it was kind of just easiest just to write out the numbers like this. And then you can see with the formula, that's the AFN formula, of course. And then let's go ahead and just kind of plug in all the numbers that were given to us. There's quite a few here. So 5 million in sales. Assets were 2.5 million. Current liabilities were 700,000. Notes payable were 300,000. Accounts payable were 500,000. Accruals were 200,000. My profit margin is 7%, 0.07. My payout ratio is 80%. And then my A0 to S0, my capital intensity ratio, let's just do the math here. Get those 50%. And then L0, my spontaneous liabilities, is the sum of the AP and the accruals divided by my sales. And I got to fix the formula here. I got to make sure I've got parentheses in the right place. Let me fix that, and that'll get me to 14%. Okay, so it's kind of important that we see it from that perspective. And then what you can do from there is a combination of kind of just rearranging the formula up here to plug in all the various amounts that we need to make this happen. So for example, what we'll do, so let me just kind of copy this formula down here. Start kind of with an area down here, and I'm going to insert some rows here. Okay, is we want to take kind of these numbers here, and I'm just going to do it like this, just so it's easy to see it all, what all the numbers are. So I'm going to just kind of force this to be a label and not be an actual formula with numbers. So we'll go 0.50 is my capital intensity ratio, and then that would be multiplied by the change in sales. So I don't know how to do the triangle, so I'm just typing in change in sales. And then minus my liability, spontaneous liabilities ratio, which is 0.14, and then of course we multiply that by the change in sales again. And then we subtract that from the combination of the margin, the 7% margin right here. And then we multiply that by S1, okay, sales for next year. And then we go 1 minus 0.8, 1 minus the payout ratio. And ultimately what we do is we can kind of just solve that, just keep solving for that using algebra. And I'll show you, we'll kind of just keep on doing that here. So the next line would be let me start by copying here this one here. So I copy that, bring it down to here, and then what I can do is I can simplify this in this next line to be 0.05 or 0.5 change in sales minus 0.14 change in sales minus 0.014. Oops, let me do it this way. Minus 0.014 S1 after I take care of the 1 minus 2. So I take the 1 minus 0.8, which is 0.2, times the 0.07 to get 0.014. So that's the simplification there. And then I simplify that again, and I get rid of the 0.14s, and I can turn this into this formula. Let me just copy and start over. So the next simplification would be this one. It'd be 0.36, because I get rid of the 0.14. So 0.36 minus this. Okay, 0.014 S1. So that's the next line. And then from there, let me copy paste down again. I have to take the 0.36, and obviously the change in sales is this. It is, I multiply the 0.36 times S1 minus S0. Minus 0.014 S1. So we're almost there. And then the next line is S1. I don't know what that is yet, but I know S0 is 5 million. Okay. Then I can do some better simplification. From there, I can do this. And then that change then, so 0.36 S1, I do that, and then I subtract from that 1,800,000. Okay, so then I get 0.014 S1 again. Then I get to, on this side, I would have 1/8 equals, and on the right hand side, what's left over would just simply be the 0.346 S1. As I simplify again, then I divide the two numbers, and then I would ultimately get, if I take the 1,800 divide by 0.346, I get my answer, which is right here, 5,202,312. So basically what we're saying is that's the amount that sales can grow by. So remember, the base year sales were 500,000, so S0 was 500,000. So my sales can grow by the difference between the two. Let me format these better. Okay. Whoops, I did some really bad math here. I did times instead of minus. There we go. And this should be 5 million, not 500,000. There we go. So S1 is 5202, S0 is 5 million. So I can grow sales just by a very small amount, 202,312. That percent's pretty low. If I take the 202,312 divided by 5 million, I would get basically 4%. So 4.05%. So that's the amount of growth that I can do and not need additional financing. Okay, so that's what the whole point of that question was. So we'll do one more, question 5, and this is doing a projection. And it says long-term financing needed. So at the year-end 19, Wallace Landscaping total assets were $2.17 million. Accounts payable was 560. Sales were 3.5 million, expecting to increase by 35%. Total assets and account payables are proportionate to sales, and that relationship will be maintained. Wallace typically uses no current liabilities other than accounts payable. Common stock amounted to 625 in 19, and retained earnings were 395. Wallace has arranged to sell 195 of new common stock in 20 to meet some financing needs. The remainder of its financing needs will be met by issuing new long-term debt at the end of 20. Because the debt's added at the end of the year, there'd be no additional interest expense due to the new debt. So they'll get the debt the last day of the year and not have to pay interest until the next year. Net profit is 5%, and 45% of earnings will be paid out as dividends. So what's the long-term debt and liabilities in 19? So let's go, and what I did is I kind of just built an income statement and balance sheet. Actually, I should just say just the revenues is all I used, but then after that I kind of just built a little mini balance sheet based on what they gave us. So they gave us all the information to build a balance sheet. They told us the assets, they told us current liabilities, current long-term debt, and these are the word prelim because that's going to change. Total liabilities, total equity, common stock, retained earnings, and so on. So we have a balanced balance sheet now in 19. And then what they're telling us is that we're going to make some changes in the next year. We're going to increase some things. So one of the things that they mentioned was that sales was going to increase by 35%. So let's go back and kind of just walk through that. So they said right here, sales at 3.5 million expected to grow by 35%. So what we can do then is go back to here and go, okay, so here's my base number. I want to get to 2020, so I just take the 3.5 million times 1.35. Okay, and I get 4,725,000. And then remember that we have a ratio of assets to sales, and it said that ratio would be maintained. Okay, and so what we did is that ratio is 62%. So if I just took 2170 divided by 35, I get that 62%. So we're just going to say that 4,725,000 times that 0.62 is my total asset number, 292,950. Same thing with current liabilities. I just take that 560, I divide it by sales, I get the 0.16. I can take that 0.16, multiply it by the new sales number, and I've got my new current liability number. Okay. We're not going to take on any new long-term debt at this point, so we're going to just kind of keep that for now at 590. Okay, and so I've got my total liabilities number. I'm just going to copy and paste this over so you see it. Okay, so I've got for now 1346. Now for common stock, what they mentioned was that we're going to increase common stock. We're going to sell 195,000 worth of stock. So the sum of 625 plus 195 is my new number, 820. And then we have to figure out the retained earnings increase. Okay, so they gave us some good information. They said that the profit margin would be 5%, and the payout ratio they mentioned, whoops, let me go to the right thing here, would be 45%. So basically profit margin is 5 and 45% of earnings will be paid out. So 55 is kept, 45% is paid out. So all we have to do is go back here and kind of compute what will be the increase to retained earnings for the next year. Okay, so what we do is we take net income, and net income would be the new sales number. I'm sorry, not the new sales number, $4,725,000. We multiply that by the profit margin of 0.05, and that's not quite there yet, but that'd be my increase to net income would be $236,250. Well, then I have to multiply that by 1 minus the payout ratio, 1 minus 0.45. Okay, and that gets me to 129,938. So basically, it's the new revenue, 4,725,000, times the profit margin times 1 minus payout. So that's my net increase to retained earnings right here. So I add that across. Okay, and I get 524,937. And I'm going to copy these formulas from the left side here to the right side. And what I want you to see then is, do we balance, yes or no? And you can see that we don't balance initially, right? So my total liabilities and equity, or my total equity, I should say, is 1,344. My total liability and equity is 2,690, and that is not the same as my total assets of 2,929. So I have to subtract the two numbers from each other, and I get 238,563, and then that's basically my shortfall. So that's my additional funds needed, and then that would mean that's new long-term debt. So that prelim long-term debt, I just put in the same number, 590, because the problem told us that after we do the stock sale of 195, anything left over will be new long-term debt. They mentioned that specifically. And so, whoops, wrong file. Let me close that one. And so what I would do then is just plug that number in here. So let me change this to be more of a formula, but let me plug in the new number. So now I need 238,563 to make this work. And so I'll just do a formula of plus the old number, plus what I plan to borrow, and now I balance, just minus and rounding. Okay, so that's how that works. So that's kind of the iteration you go through. And of course, all I would have really had to do is just make this be, I could have made this be a formula to automatically take that variance and plug it in there. You know, there's ways to do that, but that's an example of how you do forecasting. And you know, it's pretty straightforward, but I did the same process for a multi-billion-dollar company, exact same process. So it's not unusual to use this method. So hopefully that all made sense. If you have questions, just let me know.